The views, comments, and opinions of the following program do not necessarily reflect those of Morris Media Studios, morrismedialive.com, or its affiliates. Listener discretion is advised.
Good afternoon, everyone. Why am I looking up always? How is everyone today on this Wednesday, July 21st? I'm your girl, Shirley Nichols, aka Mortgage Money with Shirley. I thank you all so much for tuning in today here at the Morris Media Studios where we're taping live. So feel free to call in with any questions, comments, or concerns. If you want to call in today, we're going to put the number here at the bottom of the screen, so you'll be able to see that number. It's 323-815-4204, 323-815-4204. If you want to call in to today's show, you can. Again, we are right now streaming live on all platforms, YouTube, Morris Media Studios on YouTube. Facebook is my personal Shirley Nichols and my business page, Clear Sky Mortgage and Realty. And you'll find us. So we are streaming live right here, right now in the Morris Media Studios here in Los Angeles. It is Wednesday, the middle of the week, and it is July 21st. So thank you for tuning in with your girl, Mortgage Money with Shirley. And we are doing episode 9 today. Episode 9 with the adjustable rate mortgages versus a fixed rate mortgage. Okay? So let's go ahead and jump into today's topic. But before we get too far along, I do want to make sure that I give you all my NMLS number. I have neglected on previous shows to give you all that NMLS number. Is very important. It's 105989. Again, my NMLS number 105989. That's like your business license number, that number that says you're certified to do what you're doing. And as a mortgage broker, I just love this business, this industry. I've been doing mortgage lending for over 28 years. So as you can see, I might know what I'm talking about. So you might want to listen, join in, tag your friends, get some more people on the show to watch it, or you can always watch the replay, okay? Because I will answer your questions, comments, or concerns if you leave them in the comment section of Facebook, or if you want to inbox me directly, or if you want to call me about mortgage questions. I'm at area code 818-720-7575. I'll give you that number at the end of the show because that's my cell phone number. And if you have other questions that you don't feel comfortable with asking in front of everyone watching, because I know we've got millions and millions of people watching this show. So just tune in and stay abreast of all that's going on my YouTube channel with Morris Media Studios. Mortgage Money with Shirley is what you'll search. I've got all the previous other episodes because, like I said, this is episode 9 today, and all my other previous episodes are on the YouTube station now, Mortgage Money with Shirley, and you'll want to watch and pay close attention because there's a lot of good stuff in there. Like I said, I've been doing this mortgage lending business for a very long time, more than half of my life I've been doing this business. So again, it's so much information. It's ever changing. We're always getting trained. We have to take continuing education courses every single year. And guess what? It's the middle of the year. And they're always asking us to do our continuing education courses. So trust me, we have the knowledge and we are going to get certified, not going to get, but we are certified in what we do. And again, the continuing education courses for all of you people out there who want to know, how do y'all know this stuff? We continuously are getting educated and trained every single year. There's a test that we must take and to keep our credentials credentialized. Is that a word? Okay, so I just thought I'd tell you a little bit about your girl, Shirley Nichols. Again, is my Facebook page, and my business Facebook page is Clear Sky Mortgage and Realty. And every first of the month and the end of the month, we do these podcasts just to let you know a little bit more about the industry, especially if you're a homeowner or if you're thinking about being a homeowner. Now's the time. I always say that on my previous podcasts as well. If you're thinking about buying a home, purchasing a home, buying your first home, now's the time to do it. Interest rates are incredibly low. The forecast is they'll stay low to, throughout the end of the year anyway. I know in prehistoric, I shouldn't say prehistoric, but I mean, it seems like that because it seems like it's been a really long year already in this pandemic. But nonetheless, at the end of the year, like around the November, December months, that's sometimes historically what we've seen as an uptick in interest rates. Around those end months of the year when everyone's trying to close out their fiscal year and the economy is just getting a year-end look of what they have done in the previous year or the whole year, that's kind of when you see interest rates start to dangle around a little bit towards the end of the year. So if you're thinking about buying a house, purchasing a home, right now is a great time. You can call yours truly and I'll walk you through the steps and help you get qualified if you can. And so episode 9, adjustable rate mortgage or a fixed rate mortgage. So I get this question about 30% of the time. I don't really have a lot of questions regarding adjustable rate mortgages or fixed rate mortgages. But because I have been asked in the last week about it, I think I'll bring this to the forefront and just kind of give you guys what I know about adjustable rate mortgages versus a 30-year, a 15-year, a 10-year, or a 5-year fixed rate on a mortgage. So we're all pretty much familiar with a fixed rate loan, right? You have your 30-year fixed rate. That means that your loan is going to be amortized over 30 years. You'll have a set payment, a set interest rate, and a set due date. So basically on the first of every month, just about everybody's mortgage is due pretty much on the first of every month. And when you have a 30-year fixed rate, that balance, let's just say you have a $500,000 balance on your mortgage. That balance is amortized over 30 years for this monthly payment that you must make on typically the first of every month. And it has a certain interest rate. That's your 30-year fixed rate. They also have 20-year fixed rates. They also have 15 and 10-year. Now, back in the day, and I said this word prehistoric earlier in the podcast, back in prehistoric times when I got started, believe it or not, there were a 5-year term, a 5-year fixed rate. There was. And of course, that was for the well-to-do, wealthier client, but there was a 5-year mortgage rate term. I haven't seen those in recent days, weeks, months, years. But like I said, when I first entered into this environment of mortgage lending, there was a 5-year term, and someone would have a $100,000 or $200,000 because I got my start back in the Midwest in Kansas City, Missouri, is when I first got into the mortgage business back in Kansas City in my small little tender age. No, but back in Kansas City, the homes aren't as expensive as they are here in Los Angeles. So you could get a $200,000 home or a $150,000 home back in Kansas City. That's a monstrous big deal. And like I said, there were a few clients of mine that would take out a 5-year term. Yeah. So I don't see those 5-year terms anymore, but the fixed rate is where you're concerned at. The fixed rate, whether it's for 30 years, 20 years, 15 or 10 is about the least amount of years that I've seen is a 10-year right now. Oh, no, I have seen an 8-year as well. Yeah, there are some odd numbers. You could call us and say, hey, I'd like to see what my payment would be for an 8-year, a 9-year. Those odd number 12 years, those odd number terms are available. Now, your actual note won't show a 12-year term. It'll say a 15-year term, but you'll have a payment that allows you to pay it in 12 years. So that's pretty much how that kind of works out. But nonetheless, that's your fixed rate term. Your fixed rate term, again, a fixed interest rate, a fixed payment, a fixed due date. And that's pretty much what you're looking at as a fix. Now, adjustable rate mortgages. Now, the myth is, I'm not going to know what my payment is every month. Not on a mortgage. You will know what your payment is every month, and we'll talk about that here in a second. But on a mortgage, adjustable rate mortgage, not a credit line. So there's a difference, right? So most people think, oh, well, I want to take out a home equity credit line. And that's exactly what it is, a home equity credit line. A credit line works just like a revolving charge card. Works just like your Visa or American Express. It revolves. The balance changes and the rates change and the payments change. All of that is ever what we call revolving, right? So that is the home equity credit line. You ask for that. You ask for a credit line, not necessarily a home mortgage with a fixed rate and payment, right? So let's talk about that for a second. On an adjustable rate mortgage, what that means is the interest rate is adjusting, hence your payment will adjust after a certain period of time. Versus on an American Express or a Visa, it's every month. Every month your payment could be something new, your rate could be something different because your balance is doing this, right? It's revolving. On the mortgage side of things with an adjustable rate, your rate changes, and it's not a guarantee that it's going to change. That's the first myth I'd like to dispel. On an adjustable rate mortgage, your rate does not necessarily change unless the Federal Reserve Bank goes in and they change the rate there, right? And it also goes on with the LIBOR and some other treasury indexes that we will talk about at a later show. But those indices, on the Federal Reserve Bank and what they do over there, that is what triggers your interest rate. And if nothing happens over here, then your rate doesn't really move. Now, let's talk about that a little bit. So with an adjustable rate mortgage, there is what they call a 5/6, a 7/6, a 10/6. These are kind of the terms of what you're looking at as an adjustable. And if you want to give me a call offline, I'll kind of go a little bit more in detail about what these terms mean. But let's just focus in on the 5/6 term. Okay, the 5/6 term. What does that mean, Shirley? Well, it means for 5 years, that's the first number of the 5/6 term. For 5 years, your rate will start out, let's say 2%. Adjustable rate mortgages, by the way, are pretty darn low right now. They really are. The shorter your term, the lower your rate, right? So I mentioned 5/6 and a 7/6. We'll talk about these two in more detail. The 5/6 is a shorter term, right? That means you'll have this certain rate for 5 years. The second number to the 5/6, the second number is the length of time, right, that the rate could possibly change. Now, question I always get, will it get any lower? No. The rate can only go higher on an adjustable rate mortgage plan, right? Now, it can go lower. Let me go back. It can go lower, but it cannot go lower than your initial rate. So if you call me today, hey, Shirley, I'd like to do that 5/6 arm you were talking about. Okay, no problem. So today's rate, and this is not today's rate, I'm just going to give you an example, but this by no means, let me just declare again, disclaimer, this is not today's rate. I'm just giving you all simple numbers to kind of follow along with. So if you call me, example, if you call me Jane Doe and say, hey, Shirley, I'd like to do the 5/6 arm today, let's go. I'm going to say, okay, great. I'm going to offer you, Jane Doe, a 2.0, okay, a 2.0 interest rate on a 5/6 arm. Jane Doe says, well, what does that mean, Shirley? For 5 years, you'll have a 2.0 rate. However, in that 5 years, it could adjust in the first 6 months. What does that mean, Shirley? It can, not guaranteeing that it will, but it could. In the first 6 months, it could adjust up to 4%. Okay, that's the max cap in the first 2 years. On a 5/6 arm, if today's rate on a 5/6 arm was at 2% flat, which I think is even lower than that. I don't know, don't quote me. But the interest rates on adjustable rates are pretty darn low right now. But again, the 5/6, it's real simple. For 5 years, you're going to have a 2% rate, except for in the 6 months, the first 6 months, if the feds come in and say, hey, we need these rates to be higher, then your rate can go up to a max of 4%. It can only go up a max by 2 points in that first 6 months. The following year, it can go up by 1 more percent. Overall, just to let you know, on a 5/6 arm, the maximum that your rate can go over that initial rate is up to 8%. So if we start you at 2% on the 5-year arm, if we start you at 2%, it can go up to 10% over the course of that 5-6 arm, okay? So that's kind of how arms work. Why do people get them? Because the stinking rate is stinking low. and if by chance you're a homeowner who knows that, in about a year or so, I'm going to put my home on the market, right? These are the kind of clients that we see who enjoy doing those adjustable rates. They're the clients that, I'm going to put my house on the market in about a year or so. So this is perfect for you. Do the 5-6 arm because you know that you're really thinking about putting your house on the market. So you're going to benefit from a lower rate, 2% or maybe even lower, and then your payment will be that much lower as well. And because the interest rate is so low, guess what the principal balance is doing every time you make a payment? It's going lower and lower a lot quicker than if you would have had a 30-year fixed. So does that make sense, right? If you do an adjustable rate mortgage and the rate's like 2% flat, and you're planning to leave or sell your home in the next year or 2 years, this is perfect for you because then your interest rate and your payment, the lower the interest rate, the lower the payment, which means that principal balance is going to go lower a lot quicker than the 30-year fixed. So I hope that kind of gives you an insight on adjustable rate mortgages because like I said, you can do the 5-6 arm, you can do the 7-6 arm, the 10-6 arm. And again, it's that first number, 5-6 arm, it stays fixed for 5 years, except for in the first 6 months, it could go up, okay? 7-6 arm, same thing, fixed for 7 years. 10-6 arm, fixed for 10 years. So I hope all this kind of makes a little sense to you guys out there. If you're thinking about adjustable rate mortgages, the consumer or the homeowner that fits those adjustable rate mortgages are typically the ones that know they're going to be selling or they don't mind the market so much because right now it's pretty darn good, right? The economy is doing well enough where those rates are down, the rates are low, and they may stay low, for quite some time. So again, if you're looking to do something for the short term or even, like I said, up to 7 years, adjustable rate mortgage might be for you because you might want a lot of house, right? You might want a $600,000 or $700,000 house, but with a smaller payment. That's the arm rate, right? And then you can add more to that payment every month. You don't always have to pay the smallest payment or the minimum payment. You can always add more every month and knock down that principal balance, right? So it works hand in hand. We also have clients that do these adjustable rate mortgages because right now, I have a commission-based job or I have a sales job or something to that effect where my paycheck is not as high as it normally is during the pandemic. So perhaps I should go to an adjustable rate mortgage because my paycheck right now is kind of fluctuating. It's kind of lower than what it normally is if we weren't in a pandemic. So then you might decide to do an adjustable rate mortgage just to get that mortgage payment down, and then another myth that I want to dispel, you can always refinance out of the adjustable rate mortgage. You don't have to keep it. You can refinance out of that adjustable rate mortgage and get into a 30-year fixed mortgage, a 20-year fixed rate, a 15-year fixed rate. You can always refinance out of that adjustable rate mortgage. There's no prepayment penalty. So let's just say, oh no, the wife got pregnant. That happens, right? So your wife got pregnant, you need a bigger house, I don't know, you want to sell your house, so you want to get a shorter term mortgage, right? A lower interest rate and payment while the wife is pregnant, and then you're going to sell, so this might work out for you because your wife is pregnant, right? So those kinds of things do happen in the real world, and there's nothing wrong with the adjustable rate mortgages. Adjustable rate mortgages right now are really trendy and are trending because, like I said, we're in a pandemic and a lot of people need that smaller payment. So if you want to hear more about, refinancing into an adjustable rate mortgage, give your girl a call and we'll discuss more about it. Because again, like I said, you can always refinance out of an adjustable rate into a 30-year rate mortgage. Now, it used to be, I know sometimes I get this question too, does it make sense? But like I said, if it fits your scenario, your situation, then it does make sense to go ahead and do an adjustable rate mortgage. Because again, when the scenario stops or the situation stops, the wife has the baby or the job picks back up and your income is higher, you can always refinance into that 30-year fixed rate, right? And 30-year fixed rates, when rates started dropping real low, back really towards the end of last year, when the rates started going down, a lot of people were, why should I do an adjustable rate mortgage? Those interest rates are comparable to a 30-year fixed rate. And they really were at the time. I didn't really talk heavily, and the adjustable rate mortgages weren't really popular and trending last year because the 30-year fixed rate, 20-year fixed rate was cheap. It was low. But now that the 30-year fixed rate and the 20-year fixed rate, they're not as low as last year. They're still darn good, and they're still low. However, they're just not as low as they were a year ago. So a lot of people just kind of didn't do too much with the adjustable rate mortgages, but now, because like I said, the rates are kind of going up a little, adjustable rate mortgages tend to be a little cheaper than the 30-year fixed rate. So, again, we can talk offline about what today's rates are and, what fits your situation and your scenario, because there's lots of room for all kinds of refinancing and purchasing homes. So let's talk about another topic today of FHA. We talk about FHA from time to time on my podcast, but the reason why I bring it up today is because there's still time to refinance your FHA into a conventional mortgage without that PMI. I've been working with the client. You just got to be, mindful of today's market, right? If you're here in Los Angeles County, you really want to be mindful of today's market and the values of what the properties are doing in this area, right? LA properties are doing very, very well, mind you, in the value sense, right? In the value category, the values are going up. So if you are, and I implore you to understand this, if you are a homeowner with a mortgage, come close. If your mortgage is FHA, now's the time to really look into whether or not you have enough equity to refinance into a conventional loan. Now, why do I say that? Shirley, why are you talking about this? Because right now, if you can refinance from an FHA to conventional, you'll get rid of what we call PMI, private mortgage insurance, which, like I said, if you've been following my podcast and listening in, you know that private mortgage insurance, that PMI, only protects who? The lender, right? But there's nothing wrong with an FHA because these programs, these FHA programs, these government programs are widely used. I've used them in my first 2-3 homes. I've always used FHA, but these mortgages that are FHA, now's the time to get out of that mortgage if there's PMI, private mortgage insurance. And the same thing goes with conventional. Yes, there are some homeowners who have conventional loan program on a mortgage and that carry PMI. PMI is not just for the government FHA loan. It's not just for that. It's also conventional as well, conforming conventional, because that PMI says if there's not 20% worth of equity on your or in your property when you do your loan closing, if you're at 85% loan to value or 90% loan to value, chances are you've gotten a conventional loan program that carries PMI, right? And you don't have to have that. So what I'll say is this, let me kind of retract. If you have an FHA loan, specifically FHA, or a conventional loan, specifically a conventional loan with PMI, now's the time you should be refinancing. But Shirley, if I refinance my FHA rate that's at 2.75, then I'm going to get a conventional rate at 2.875. Who cares? It's an 1/8% difference. And that 0.125, that 1/8% difference is not going to overtake the savings that you're going to have if you get rid of the PMI. So again, I implore you to listen real good. take out your FHA mortgage statement, right? Or your conventional mortgage statement. And you'll read, they have to itemize out what they're billing on these mortgage statements. And they'll itemize out principal, $200. Interest, $3,000. But they'll itemize out what your payment goes to specifically every month. It'll say principal amount, interest amount, escrow or impound amount. And if you have, there'll be a line that says PMI, or it'll say HUD insurance or something to that effect. That PMI or that line that says HUD insurance, that's what you want to rid yourself of. It's not needed if you've got 20% of equity. Well, Shirley, how do I know if I got 20% of equity? You call me, right? You call me, and I'll give you an estimated value of what your property is shows for the value. Or I'm pretty sure your neighborhood, they may send out flyers that says, hey, I'm the real estate agent ABC over here, and we've sold this property next door for $1 million. So just check your mail. There's sometimes flyers that'll come out that'll say your neighbors have sold, or they'll tell you, hey, we've valued your property at this or that or whatever. But like I said, you can always call me, and I've got resources that will show what the value or the estimated value of your property is. And then we'll compare what is owed on the balance of the property, and we'll compare those numbers to see if you've got 20% worth of equity. If you got 20% worth of equity and you're still carrying that PMI, that private mortgage insurance, I'm going to strangle you because you can get rid of that, okay? If you do an FHA loan, however, if you call me to refinance your FHA into another FHA because you want to pull out cash, or your credit score is maybe not quite high enough. By the way, if you want a conventional loan, right now we do have lenders that will look at your 620 FICO score. So if you've got a middle score of 620, give me a call if you want to get into a conventional loan and get out of your FHA and you've got that 20% worth of equity. But again, I will say, hands down, every single time you will hear it from me, your girl Shirley, Mortgage Money with Shirley, you will hear it from me. There's absolutely nothing wrong with doing an FHA loan. Nothing wrong with that. There's so many good programs. They're government loans that are geared toward the consumer. They really want to help and make sure the consumer is okay. But the price of that is your PMI or your private mortgage insurance. And like I said, that happens to conventional loans as well. So just look at your statement and see if there's a line that says PMI or HUD insurance. That's what you want to make sure you're removing if you want to do a refinance. So again, we talked about the adjustable rate mortgages, the fixed rate mortgages, the FHA. The last thing I want to just mention real quick before we have to go, because again, this time goes so stinking fast. I tell you it does. And because I love to talk about this stuff, with Clear Sky Mortgage and Realty, we talk to so many clients all day long, and it's so much fun, but everyone is their own individual profile, scenario, situation, and we're just here to help. But a lot of the times stuff changes in this mortgage industry so rapidly that Monday, hey, I thought you said, Shirley, we only needed a 620 FICO score. And then on Tuesday, guess what? There's been a guideline change. We can go 600. Changes happen and occur in this business. And that's to be expected. And that's why I'm here twice a month to hopefully guide you and educate you just a little bit more on things that I know and hopefully can share with you so that you'll know as well. Last thing, like I said, I want to just briefly touch on, and I try to bring this up on most of my podcasts, is that reverse mortgage. Reverse mortgages do work. They're great. They're fantastic for the specific client, the specific homeowner, right? Reverse mortgage, I'll say it again, it's not for everyone, but it is a great tool to have if you're that homeowner that's over 62 and a half years old, you don't have any heirs to your property, you pretty much said, well, I'm just going to leave my property to Oprah. She doesn't need it. Don't worry about it. She's good without it. Or, that kind of homeowner, right? If you're a homeowner of 62 and a half years of age, you are partially eligible to become a reverse mortgage candidate. Now, why do I say that, Shirley? Well, because you still have to qualify for reverse mortgage loans. So I know that's an eye opener and probably a sticker shock, but You do. You have to qualify for a reverse mortgage. And it's not so much of how much money you have in the bank or that kind of thing, but your credit. Yeah. Believe it or not, your credit still has to be decent in order to qualify for a reverse mortgage loan. It needs to be decent because they need to know that you're still going to pay your property taxes and your annual homeowner's insurance. Yeah. And that from time to time will keep certain homeowners from being eligible for a reverse mortgage. Yeah, unfortunately. With the reverse mortgage, what it says in that reverse mortgage note is you are not mandated to have to pay a mortgage every month. But what you do have to do is pay for your property taxes and your homeowner's insurance. Now, if you're that client that actually says, well, is there a way that they can go ahead and pay the property tax and insurance for you? They can, right? But they typically take away so much of the monies that would be given to you. They typically take away so much of that, what they call the set aside. They set aside enough impound, basically your property tax and insurance. They set aside enough payments for up to the life expectancy, I think they have for the woman, of 86 years of age. So just imagine you're 62 and a half years of age and you say, well, I want them to do a set aside for my homeowner's insurance and property taxes. They'll do it, but you're talking from 62 and a half to 84. You're talking 20 plus years of set aside payments. And if you were going to get back in your hand the first year of doing the reverse mortgage, if you were going to get back, let's say $50,000, well, all that's gone. That now has been removed because you wanted them to do a set aside for your homeowner's insurance and property taxes. So that's why, again, the lender will do that. However, it's typically a forced situation where the homeowner doesn't have a choice. Because again, if their credit is such, or they've been late paying their property taxes or even homeowner's insurance, if they're late with any of this stuff, then they will force place a set-aside account. They'll force place it. So again, that homeowner who thought, oh, I'll get back $50,000 doing a reverse mortgage, don't make a payment, blah, blah, blah. Well, they've taken away your $50,000 because of the set aside that they have to use for your property taxes and insurance. So do be mindful if you are a candidate for a reverse mortgage, which is, like I said, it's not a bad program, but it's specifically geared to that specific homeowner who, like I said, maybe doesn't want to keep their house in the family, or if they have no family, or if they just want to live mortgage free, and just make their impound account payment. That's that client, they still want the comforts of their home. They don't want to move. They like where they're living, their location. They know where everything is at in the bathroom, in the kitchen. They don't need any help. That's the program for that client. And like I said, I close reverse mortgages every month, just about. And there's plenty of reasons why we still close these reverse mortgages, but the main thing about the reverse mortgages, again, you still have to be eligible for those. And there is a reverse mortgage refinance, right? What we call a HECM. And then there's a reverse mortgage for purchase. Yeah. So you can use a reverse mortgage program to buy your next home. But again, 62 and a half years of age, and you still have to qualify with credit and income. Oh, I will say that. Now, I know you're probably thinking, well, what does the income have to do with it? Well, they look at a lot of the residual income, right? That remaining income after you've paid your, and I don't want to say utilities, but let's just say you still have a car, right? Let's say you're 83 years of age and you're still driving your fancy Cadillac with the chromed out wheels and the drop top. So you're still driving that, and by golly, it still has a payment on there. Well, your income, even though most of our clients who do the reverse mortgages are on a fixed income, nothing wrong with that at all, but they're on a fixed income, the lender is looking at what's on that credit report. And if that Cadillac Brougham with the drop top, if that payment is still on there, they're going to take that out of your income. And so all of this, again, all factors into what they're looking for, which is your residual income. They're looking for this number. And that number still has to qualify to what? pay for your property taxes and insurance. Yeah. So again, give me a call is what I like to say about the reverse mortgage, because it's a really nifty tool for the right homeowner. And we close them monthly. So really nifty tool. I like them a lot, but they're called a reverse mortgage because you got to keep in mind the regular everyday 30-year fixed rate adjustable rate mortgage, they're forward mortgages, right? They're forward moving mortgages, which means basically the principal balance is going down. On the reverse mortgage, the reason why they're called reverse mortgages is they move in the opposite direction, or the reverse. Their balance is not going down, it's going up. Okay? So you might start with a $100,000 balance in 2021, but by 2022, that $100,000 balance is now $110,000. So be mindful about these reverse mortgage programs, because again, the balance works in the reverse. It goes up versus down. So guess what? It is past my time. But again, I thank you so much for being on today's podcast with me. I'm your girl, Shirley Nichols, on Facebook, my business, Clear Sky Mortgage and Realty. And we are streaming live here on YouTube, Morris Media Studios. If you all have any questions, comments, or concerns, please leave them in the comment section or inbox me, or give me a call on my cell phone. I'm here to answer your questions, or I will definitely call you back. I'm at 818-720-7575. You're on with Mortgage Money with Shirley. Thank you so much for your Wednesday. Have a best one.